Thank you everyone for joining us today. I do want to say a special thank you for those of you who are joining for the December session that I wasn't able to make. I really appreciate you attending this webinar. We have a lot of information to get through today. Honestly, I think we could do this webinar and keep it for 3 hours. So if I'll keep an eye on the clock, and if I feel we're running out of time, I'll skip some of the slides that I think you can read on your own. My contact information is there. Please email me if you have a question on that slide, or if you have a question that you put in the chat box that we haven't been able to answer due to the time. We'll try to get everybody out of here in an hour. So with that, let's go ahead and get started. So here's some items that we're going to go through today. So the big news is the extension of our 2019 due dates for those 1094 and 1095 forms. So just like in prior years, they have been extended. That extension came out via IRS Notice 2019-63, and that came out on December 2nd. Just like in prior years, it only extends the forms that you give to recipients or employees. It does not extend the due date to get those forms to the IRS. So that due date for the forms going to the employees or recipients is now March 2nd. For your forms, when you're doing the forms, if you're paper filing those forms, it's important to note that that due date is February 28th. It's not the last day in February. So since we have 29 days this year, make sure that you're doing it by the 28th. Also, what we've seen some employers do is they mail their forms to the IRS right on the 27th or 28th, and the IRS is penalizing them, saying they didn't get the forms in time. So obviously they were mailed in time. They shouldn't receive a penalty. If you are mailing forms for your clients, I would encourage you to mail them a week beforehand, and I would certify mail them to the IRS. Have some kind of copy that the IRS did get those forms in time. Also, what we've seen is if you're e-filing those forms, you should get a confirmation back that the IRS accepted those forms. We've seen it where the IRS has not accepted those forms, so they're getting a 972CG penalty saying that those forms weren't filed on time. If you're using a payroll software, make sure that the payroll software is submitting those, or you are submitting those, so you don't get that penalty. So in that notice, there is some relief that you can get. Instead of giving those forms to employees, you can put a notice on your website, and that notice can say, hey, if you want a copy of this 1095C or B form, I'm sorry, you can ask the employer to give a copy of it to you, and the employer doesn't have to mail that copy to you. I would suggest not doing this. This relief, I think, it's good for only those large insurance companies. If you are having 40 forms, let's say you have 40 forms, a 1095B form, and you're giving those B form to your employees, give them to your employees. The filing requirement with the IRS has not changed. It is still the same. You are saving $20 in postage if you don't give those forms to employees. Go ahead and give those to employees. I think that relief that's on that notice is only for those large insurance companies such as Blue Cross Blue Shield, Health Partners. If they've got 1 million forms, they're going to save $500,000 in postage by putting that notice on the website. They still have to file those forms with the IRS. So you still have to prepare those forms. Go ahead, send them to the employees. Otherwise, if you don't and you put a notice on your website like that's in that 2019-63 notice, then every time someone wants one of those copies, they're going to have to email you, call you, and you're going to have to send that employee a copy of their form within 30 days. Go ahead, mail those forms out to the employees. Like I said earlier, you still have to submit those forms to the IRS, so you're not saving any time with preparing those forms. Also, with the 2019 forms, we do have that good faith effort reporting. You do have to make sure that you show that you made a good faith effort in order to get those penalties abated if your forms are wrong. So I'm sure everyone saw in December of this past month, the Fifth Circuit Court of Appeals did rule on the Texas versus United States court case. obviously they ruled that the individual mandate is unconstitutional. However, they sent it back down to that district judge and said, you know what, you need to look at this a little bit further. You can't just say that the individual mandate, because it's been brought down to 0, it's deemed unconstitutional, and the rest of the ACA is now unconstitutional. So specifically, they said, I'll read it verbatim, it said the district court to employ a fine-tooth comb on remand and conduct a more searching inquiry into which provisions of the ACA Congress intended to be inseparable from the individual mandate. They go on to say it is no small thing for an unelected, life-tenured judges to declare duly elected legislation passed by elected representatives of the American people unconstitutional. So it's sitting back down with that district judge in Texas. However, if you read through everything and if you watch the media, the California Attorney General did say that he was going to try to get the Supreme Court to hear the case before the district judge could rule on it. So in fact, last Friday they did that. They sent it to the Supreme Court, asking the Supreme Court to hear it. Now, if you know how the Supreme Court works, they have to have 4 of the justices agree to hear the case, to take on the case. A 5th justice is needed in order to expedite that hearing and hear it this term. We don't know if they'll do that. I'm guessing they're not going to. They're going to kick the can down to next term. And so we probably won't get anything resolved on it this year. I would anticipate. With that being said, we do have some states now requiring individuals to have minimum essential coverage. And with that, there is some filing requirements that employers will have to do. Now, specifically for 2019, we had New Jersey and Washington, D.C. come to the table. Next year, we'll have some more. We'll talk about that in a minute. What that means for you, if you're an employer listening in, or if you're a CPA listening in and you file those forms for your clients, you have to make sure that if you're, let's say you're in Oklahoma and you're filing those forms for an Oklahoma client, you need to make sure that that client didn't have anyone living in New Jersey for maybe 11 months of the year. You wouldn't know that if you get their year-end information, right? Because if they move to Oklahoma in December of 2019 and you're filling out their 1095 forms, you see an Oklahoma address for the employee, you wouldn't know that that employee worked for that client in New Jersey for 11 months of the year. If that's the case, that client would have a filing requirement in New Jersey. So what we've done is we've actually changed our engagement letter, and we've on our engagement letter said we're filing the federal forms and we'll file any state forms that you list. Put that ownership back on that client, because if you've got a client that's filing a couple hundred forms, even if you have a client that's filing 60 forms, you may not know if that client had an employee working for them in New Jersey or DC for part of the year. So again, watch those. Just like when we do a tax return, that client's anticipating that we're going to file the federal and any applicable states. Same with this. If they know we're filing their ACA forms, they might just anticipate we're filing the federal along with any applicable states. Now for next year, we have California, Rhode Island, and Vermont coming to the table. There's some more guidance that will be issued on these states, so watch for that. But again, for 2019, the only new ones are New Jersey and DC. So here's some ACA terms. I anticipate that everybody on this call is familiar with these terms. We're just going to do a review of some of the terms. Again, like we had stated, that individual mandate is now brought down to 0. We still have all the same form filings to do, the 1094B and the 1095B. Now, back on that notice in 2019-63, that was the extension notice that we had mentioned earlier. The IRS is asking for comments on whether you feel this extension and the information on these forms, what you feel is necessary. So if you look at the last page of that notice, it's actually page 10, it asks taxpayers and reporting entities to let them know their thoughts. It would be nice if we could get that extension permanent. However, since we still do have the filing requirements for the B and the C forms, make sure you get those done on time. Now, what does this federal mandate being brought down to zero mean? I think it could mean we could see clients with lower 4980HB penalties. Remember, that is the $3,000 penalty. It does get ratcheted up every year for inflation. But that is the penalty. Remember that if you have an employer that offers unaffordable insurance and one of those individuals that received that unaffordable offer goes to the exchange and receives a premium tax credit, that employer is going to be hit with a $3,000 penalty. Remember that B penalty, it's just for every individual that goes to the exchange and receives a premium tax credit that didn't get an affordable offer, that employer would be penalized for. And now I say I think it's going to reduce the B penalties and not the A penalties. Remember, the A penalty is the larger of the two, but the A penalty, it only takes one person to trip that penalty for the employer. Whereas the B penalty, it's just on those employees, excuse me, that go to the exchange and receive a premium tax credit that employer is going to be hit with that penalty on. Well, since individuals aren't mandated to have health insurance, I had assumed that fewer people are going to go to the exchange, qualify for a premium tax credit, therefore less of those people will have the penalty go back to the employer. So I put this slide in here. I'm hoping one day I can take it out. I still see people, I still reimbursing for individual health insurance. I even see practitioners doing it. I've seen practitioners do it, and when they fill out the paychecks, they're putting it on the paychecks. You cannot reimburse for individual health insurance premiums. There is a penalty associated with that. It's actually the 4980HD or 4980D excise tax, and that's $100 per day per person. And that's a self-reported penalty. So if you're a practitioner out there that has knowledge that your client is doing this, it's actually self-reported on the tax return. You are supposed to put that $36,500 penalty per employee that received that reimbursement on that tax return. Now, there is some exceptions. If you have a QSERA or starting in 2020, if you have those new individual coverage HRAs, or if you have an HRA that has less than 2 participants, those would not be subject to the $100 per day per person penalty. Now, here's some backup notices and the DOL FAQ that announced those notices or announced those penalties. Remember, the DOL came out after that IRS notice and said it doesn't matter if those dollars are reimbursed to employees in their pre-tax or post-tax. It's wrong, period. Both of them would be subject to the $100 per day per person penalty. Now, the HRAs, like I said, there are some instances where they can be utilized. If you have an HRA with fewer than 2 employees, or if you have an HRA that's integrated with a group plan. We don't see a lot of those HRAs. If you do have an HRA that's integrated with a group plan, you're going to want to make sure that that plan document was updated or looked at by an attorney after the ACA came out. Also, HRAs for HIPAA accepted benefits, those are allowed as well. Remember, you still have to worry about the non-discrimination rules. So Amy, we're going to go with our first polling question. I will read that. Employers cannot reimburse for individual health insurance premiums, excuse me, except for plans with less than 2 employees, unless they have a QSERA or starting on January 1st of 2020, an ICHRA. Perfect. All right, so that is true. You cannot reimburse for those individual health insurance premiums. So the 2% shareholder rules, we still get questions on this. So old rules still apply. So pre-ACA rules still apply to those shareholders. You can reimburse shareholders for their individual health insurance premiums. However, it's important to note that if you do reimburse shareholders for their individual health insurance premiums, you can't have someone else that's not a 2% shareholder get reimbursed for that their premiums, have that less than 2 HRA out there. So you can have one or the other. Make sure you're watching that. Put them in box 1, 14, and 16.
So now we're going to talk about the new ICHRAs out there. You know, at first I thought these new ICHRAs weren't going to be very used very much, I should say. I'm seeing more and more employers using them for different reasons. We'll talk about that in a little bit after we talk a little bit about the ICHRAs and what you can do with them and what you can't do with them. So they obviously start on 1/1 of 20. They can be used for both premiums and medical expenses. Any size employer can have an ICHRA. You have to have individual coverage if you take that ICHRA from the employer. So individual coverage can include Medicare, not counted. I get questions on that healthcare sharing ministry. That is not considered individual coverage for these ICHRAs. You cannot offer a group plan and an ICHRA to the same group of employees. Now that's different than the QSARAs. Remember, if you have a group plan, you can't have a QSARA. You can have a group plan, you just can't offer that group plan and the ICHRA to the same individuals. They'll tell us the groups of employees here in a bit. There's no limit on contribution, so you could put $100 into that ICHRA per year. You could put $10,000 into that ICHRA per year. Remember, that's different than the QSARAs. The QSARAs, they came out December, I think 2016. So the ICHRAs are different in that you can put as much money in there. Now it's only employer funds that go into the ICHRA, not employee funds. Controlled groups rules do not apply for ICHRAs, so they don't have to be consistent across the board with related entities. So like I said, the employer decides the contribution amount. However, it has to be the same dollar for all employees in the class. You can vary it based on the employee age. However, that ratio can't be more than a 3-to-1 ratio. You can also vary those dollars according to the number of dependents. So unlike the QSARA, you could also offer a benefit like an FSA with your ICHRA. Individual plans, if you're giving an ICHRA to your employee and you want to change your plan document, you could allow that individual to run the rest of their premiums through a cafeteria plan so that they can put the rest of their premiums, get them pre-taxed. Remember, if you go to the exchange and receive individual plan off the exchange, you cannot get the rest of those premiums pre-taxed. So if an employer funds an ICHRA with $100 per month, the employee purchases an off-exchange individual policy for $250 a month. If the plan document allows it, the remainder of that $150 could be pre-taxed through their cafeteria plan. A bit of a nice little benefit there. Here are the different classes you can use with the ICHRAs. It's continued on the next page. What I tend to see the most is people break the ICHRAs up into salaried versus non-salaried. So in other words, they would give the hourly employees the ICHRA and they'd give the salaried employees a group plan. There is a minimum class size, however, if you're going to do that. So if you give the ICHRA versus a group plan to either salaried versus non-salaried, full-time versus part-time, or employees in different geographic locations, you do have to meet a minimum threshold in that ICHRA. So if you have under 100 employees, at least 10 employees must be in that group that you're offering the ICHRA to. So here is the downside of the ICHRA, and this is why I thought the ICHRAs wouldn't be used as much as I'm seeing them being used. You have to give employees a notice 90 days before the start of that ICHRA, and that notice has to say, listen, if you take this ICHRA, in other words, if I tell my employer, yes, I have individual coverage, I want that ICHRA, I am no longer eligible to receive a premium tax credit. So you have to spell all that out in a notice to the employees 90 days before the start of that ICHRA, so they're well aware of the different issues with the ICHRA, so to speak. Now there is a sample notice that the IRS gives you. If you go and look for the FAQs from the IRS on the ICHRAs, it will have a sample notice. You'll have to modify it. And they'll also have the attestation statements in there. Another thing that happens is once the employee says, yes, I'll take that ICHRA, they they have to sign an attestation statement by the beginning of the plan year for that ICHRA saying, I do have individual coverage, so I qualify for this ICHRA. Now, again, those attestation statements, samples of them are in that notice or on that FAQ that the IRS put out. Then, once the employee has an expense, maybe they have premiums that they want reimbursed for the ICHRA, or they have a medical expense that they want reimbursed for the ICHRA, they have to sign a second attestation statement, give that and a copy of the expense receipt to the employer so that they can get the funds back from the employer. So originally I thought this is a lot of work for those employers, right? They have to give a notice to all their employees. They have to get all the attestation statements back for the employees that want the insurance saying they do have individual coverage. And then every time the client wants a reimbursement from that ICHRA, they have to get a second attestation statement with that receipt in order to get those funds out. So there is going to be a lot of legwork, I feel, on the employer's part if they offer these ICHRAs. The nice thing about the ICHRAs is the ICHRAs can get the employer out of the pay or play penalties. So as long as the employer is offering the ICHRA to 95% of the full-time employees, they will avoid paying in that 4980 HA penalty. Now that ICHRA has to be affordable if the employer wants to avoid the 4980 HB penalty. I'm a huge advocate, whether it's the ICHRAs or whether it's a group plan, not to worry about that 4980 HB penalty. If I have to make that affordable for all of my employees, I'm going to have to pay more either in my group insurance premiums or in my ICHRA to make that affordable for all employees across the board, when I may only have 1 or 2 employees that go to the exchange, say that the offer I made was unaffordable, and receive a 4980, and then I would receive a 4980 HB penalty for that employee. So let's say I have 100 employees, I offer an ICHRA to those employees, it's unaffordable, but I offered it to 95% of my full-time employees. I would be hit with a $6,000 penalty, right? If I have 2 people that go to the exchange, trip that B penalty, it's $6,000. Well, if I had to make that ICHRA affordable to all 100 full-time employees, it's going to cost me a lot more than $6,000. I understand penalties are non-deductible, so for our for-profit entities, there you do have to consider that. So affordability, what is that affordability for the ICHRAs based on? It's based on the lowest cost silver plan in the exchange where the employee lives. If it's affordable, then it's deemed to meet the minimum value standards. You can use the same affordability safe harbors that you used with all of your other group insurance offerings. You cannot get a premium tax credit if you take the ICHRA. So I would caution employers, I get that if you offer, let's say you offer $500 in an ICHRA per year, and let's say the employee takes that ICHRA, if they didn't understand that notice that you gave to them, they're going to short themselves by the premium tax credit they could have received. And I know that the employers are saving $2,500, right? A $3,000 penalty minus the $500 you're putting in the ICHRA. The employer is saving roughly $3,000 or $2,500. Obviously, that $3,000 penalties ratcheted up due to inflation, but in our example, they're saving $2,500. That premium tax credit that that employee is no longer eligible for is probably a lot more than $2,500. So I would caution the employers out there, make sure that your employees understand how this works, not where they take that ICHRA and short themselves maybe a $20,000 premium tax credit. So here's an ICHRA example. Let's say that Sam earns $50,000 a year and his employer gives him a $500 a month into his ICHRA account. And let's say that his premiums are $950. Well, as you can see down there, that is deemed unaffordable to Sam. So Sam would be able to go to the exchange and receive a premium tax credit. However, if Sam accepted that ICHRA, he is no longer eligible for that premium tax credit. So we're going to come to our second polling question, true or false. An employer with 250 or more full-time employees can offer an ICHRA to all employees and not be subject to the 4980 HA penalty. Perfect. So that is actually true. I'm going to give you a couple client examples that I have. I've had several clients that they're getting hit with an ESRP because they didn't offer insurance to their employees, either because that they couldn't find a group plan that was affordable for them as an employer, or they couldn't find a group plan that their employees would want, and they couldn't get enough employees to sign up for it. Therefore, the premiums were going to be higher. So they're getting hit with a large ESRP, that's that employer shared responsibility payment. Perfect when these employers come to me and say, what do we do? Well, the ICHRA, they can put $500 into an ICHRA for every one of their employees, and they can avoid that 4980 HA penalty. And they can have 500 employees, and that can save them huge dollars, as that 4980 HA penalty, remember, is tripped on all of their full-time employees if someone goes to the exchange and trips that. I do have employers that are doing the ICHRA also just because they want to offer some sort of benefit to their employees, but they don't quite want to get into the offering group insurance yet. Their penalties might be small, so there's no really advantage to them going and getting a group plan. Maybe their penalty is only $15,000. So that by all means isn't going to force them to get a group plan, but they still want to offer something to their employees to keep up with the Jones, so to speak, so that they can stay competitive in the market. So along with the ICHRAs came out these accepted benefit HRAs. I really don't see these being used a lot. You do have to offer a group plan in order to offer this benefit to your employees. The employee doesn't need to take the insurance in order to get this benefit, however. The benefit's only $1,800, again, fully funded with employer dollars. So there are some proposed rules that employers can rely on as far as that lowest cost silver plan in the marketplace. So what this is saying is in the proposed rules, it says to, to deem it affordable, we look at the lowest cost silver plan in the marketplace for that employee. Well, I could have employees of all different ages, so then I would have to go to the exchange and look for the lowest cost silver plan for all those employees. I can use the lowest cost silver plan for the lowest age group that I have, and then use that same policy for all of my employees. I would still have to see what that is per their age, but then I wouldn't have to go back to the exchange and look at all the different policies to see which one is actually the lowest cost silver plan. Uh, Also, there's a location safe harbor out there. This could apply to some. I'll go ahead and let you read through that slide. As far as the affordability, we talked about that it's still based on those 3 affordability safe harbors that employers could use with their group plans. You're going to want to use those consistently, just like you have to use in your group plans. There's a look back safe harbor as far as when you look at the cost of that plan. I'll let you go ahead and read that just due to time. Now remember, you're large employers. I think everybody knows it is 50. It's 50 full-time equivalent employees. It's always based on the prior calendar year, however. So remember, if I am a large employer, that must mean that the prior year I looked at all my employees' hours, and remember that threshold is 120, not 130 for the ALE calculation. I look back at those prior year hours, and if I hit 50 full-time equivalent employees, I am a large employer. Well, now it comes to the question about when we acquire a business. So if you acquire a business, you don't get to just take it back and look back at the prior year hours. If I have a business that has 30 full-time equivalent employees and I acquire another business that has 45 full-time employees, on the date of that acquisition is when I'm a large employer. So you're going to want to make sure that you know if your client acquired any businesses with full-time employees in that business, because they might be thinking that they look back at the prior year hours, and the prior year they didn't have that acquisition, so they weren't a large employer. So with that, that's our second polling question. ABC Company has 40 full-time equivalent employees for 2019 and acquires XYZ Company on September 1st. XYZ Company has 30 employees. When is ABC Company deemed an ALE? Perfect, September 1st of 2019. So remember, if you acquire a business, the date of that acquisition is when you become a large employer if the combined business has 50 or more full-time equivalent employees. So here are your updated penalty amounts. That 4980 HA penalty is now up to $2,500. The B penalty is no longer $3,000, it's up to $3,750. Like I said, that increases every year due to inflation. So remember how that A penalty works if I have 100 employees and one of those employees goes to the exchange and I hadn't offered in insurance to 95% of my full-time employees, I will get hit with that A penalty on all of my employees minus the first 30. So I would have that penalty on all 70 of my employees. So here is that calculation. Obviously, penalties are not deductible. And if you've seen an IRS ESRP, those are those letter 226J notices. You'll see on page 4 of that notice, there's an ESRP table, and the IRS actually will calculate that penalty per month. So go ahead and look at that. If your client gets one of those notices, make sure that calculation is done correctly. If you're part of a controlled group or your client's part of a controlled group, odds are that calculation's not going to be done correctly. What the IRS does on those notices is they say, hey, listen, you have 5 related entities. We're going to give each entity 1/5 of that 30 free employees. And so each entity would then have 6 free employees. Well, I've talked to the IRS several times on this as that's not how the regs are written. The regs are written as that 30 number should be prorated based on the number of full-time employees. And you can get that obviously from page 2 of your 1094. So if I have one entity with more full-time employees, they would get more of that 30 number than an entity with maybe 1 employee. So if you do see that on one of those notices, you'll have to send a chart back to the IRS, ask them to reduce the penalty and show them your calculation as to why that entity gets more of the free 30 number. So here is the B penalty. Remember, that is if I offer substantially all, and remember substantially all is 95% of my full-time employees' insurance, and one of those employees goes to the exchange and receives a premium tax credit because I didn't offer them affordable coverage. This will be the penalty, but it's only on that one employee, and that penalty is always maxed by the A penalty. So they're never going to penalize you for trying and failing more than for not trying at all. So our threshold this year for affordability has now increased to 9.86%. Remember, we can use the box 1 wages. We can use the rate of pay at the beginning of the plan year. Multiply that rate of pay by 130 hours. Every year I see clients coming in and they think that they get to use 2080 hours per year for that rate of pay, and that's not true. You get to use 1560, which is 130 hours a month. Obviously, that federal poverty line, that's the best one to use. Those are your 1A offers. If you offer your employees insurance that costs $99.75 for self-only premiums for them, you could use that federal poverty line for 2019. Watch out for those plans that meet minimum essential coverage but not minimum value. If you have a client that has those plans, you don't get to utilize any safe harbors in line 16 of your 1095C form. New employee. We get questions on this all the time. I see some employers want to call everybody a variable hour employee and therefore stick those employees in a look back. Remember the look back measurement method. We get an initial measurement period. Those full-time employees don't get an initial measurement period. They need an offer of coverage by the 91st day in order to avoid any penalties. So look at that employee. How are they being hired? Are they replacing a full-time employee? How did you advertise for that job? In that job interview, what did you anticipate that employee working? Did you tell that employee they had to work 30 hours a week? If so, they should come on as a full-time employee. Remember, when I'm looking at the full-time employees, I can use a monthly or a look back. But that first 12 months of hire, if I'm using a look back, that IMP is only meant for my variable or my part-time employees, not my full-time employees. Full-time employees will eventually fall in the look back measurement method. Once they complete one full look back measurement method, then we look at that look back method for the full-time employees. Until then, we measure them monthly. This is a huge misconception out there. I see clients wanting to throw all their employees in an IMP, determine if they're full-time or not, and then make that offer of coverage for them. So here are some healthcare reform terms. These should all be a review. Nothing here has changed since the ACA came out. We have that look-back measurement period, which is also called the standard measurement period. That applies to all your ongoing employees. So if you're employed for at least one SMP, that's the period you look at. Now remember, those new employees that are coming on, they also get an initial measurement period. But that's their first 12 months of hire. And if they're full-time, meaning they hit 15, 60 hours in that IMP, they need an offer of coverage right after that IMP. Then you're also going to measure those employees in their SMP, and those two are going to overlap. Remember, wherever the employee is deemed full-time is where they need that offer of coverage. So several places in the ACA where the employee, so to speak, always wins, this is one of them. So wherever that employee hits that full-time hours, whether it's after the SMP or the IMP, that's when they need an offer of coverage in the following stability period. Now, the stability period, the ongoing stability period, should always match the plan year. You can have a stability period of 6 months. I wouldn't encourage that. We've done studies on different clients, and if we have a look back for 12 months and a stability period for 12 months, that always seems to work better for clients. We have a longer period where we can stretch those employees' hours out, and hopefully more of those employees fall under 1560 where they're not deemed a full-time employee. Now, we can still offer them coverage. We can say we offer part-time employees coverage. Maybe we offer someone coverage if they work 25 to 29 hours. But remember, we wouldn't be hit with a shared responsibility payment on those employees that are deemed part-time. So hours of service, remember, when we're looking at those hours of service for those employees, it's any hours paid. So it's your vacation, it's your holiday, it's your jury duty. Any hours that we pay those employees for is considered hours worked for the look back or the monthly. Now, if we're using the look back and we have an employee in one of these special unpaid leaves, so let's say someone's out on FMLA leave, those work just like it works when you have an educational institution, how you prorate those hours for those summer months. Similar situation here. If I've got someone out on FMLA for 3 months, when I'm looking at their look back period, I would take their hours over the 9 remaining months, times it by 130, and if they worked that many hours or more, they would be deemed full-time for the next stability period. So rehired rules, this again hasn't changed, but I seldom see this being used correctly. So if we rehire an employee and they're rehired within 13 weeks, they don't get a whole new waiting period. So let's say that I have a waiting period that is the first of the month following 60 days, and I hire someone after 12 weeks of them being terminated. I have to offer them coverage as soon as administratively possible. And then the regs go on to say the first of the following month is deemed as soon as administratively possible. So I don't get to wait that full 60 days and then offer that employee insurance. If I do, Then that first month of rehire, I'm going to have a safe harbor code. I'm going to code them as starting employment again, right? But then the next 2 months, I don't get a safe harbor code. It would be a 1H, no offer, blank on their 1095C, and you're going to be open for penalties on those. Now remember, if you're an educational institution, that is a 26-week rehire rule, not a 13-week. So normally if someone is full-time in their look back, they are locked into their status and their stability period. So if I work 15, 60 hours in my look back, I'm going to be deemed full-time in my stability period, regardless of the hours I work in that stability period. There is a caveat in the rules, and this caveat can save a lot of employers some penalties. And what that caveat says is if I was offered insurance that met minimum value when I was first hired, obviously after my waiting period, and if I take a part-time position and I average under 30 hours a week for 3 full consecutive months, on the first day of the 4th month, you can call me a part-time employee, measure me monthly until I hit 1 full SMP again. So let's talk about how that works. So let's say on April 15th, I drop down to a part-time status. Eide Bailey would have to offer me insurance May, June, July. On August 1st, they can call me a part-time employee, drop my offer of coverage. Obviously, I would be eligible for COBRA continuation coverage, right? They can drop my offer of coverage and start measuring me monthly. And as long as I hit under 130 hours a month, then they wouldn't have had to offer me insurance. Now, some employers have come to me and said, well, Tanya, if I have to pay for their insurance for 3 full months after they drop down to part-time status, I have to pay the portion of their health insurance premiums. The penalty for 3 months is cheaper than what I would have to pay for their group health insurance for those 3 months. That is true. Remember, health insurance is deductible, the penalty is non-deductible, so take that into consideration. Another big issue that's overlooked is I see employers that are not offering 95% of their full-time employees health insurance. If you offer 94% of your employees health insurance, it's as if you offered no one health insurance, and you're subject to that 4980HA penalty. So this can really hurt those employers that are using the monthly method and they're looking at employees month to month to month, because you don't know till the end of the month which employees are hitting 130 potentially. So if you go out to our website, pull up that Two Unlikely Cousins article. We wrote that article back when the ACA penalties first started. So it's got the 2015 penalty amounts in there, but the reasoning behind the article is still applicable. So I'd encourage everybody that has clients that are using the monthly method to go back and read that article, and so you can tell the clients this is the benefit to using the look back. I get when you're filling out your 1095C forms, the look back is a little bit more time consuming, but there is a benefit to it. Now, notice that in 2020, our safe harbor percentage decreased. Remember, for 19, it's 9.86%. Now, coming into 2020, it's 9.78%. So you're going to have to adjust those wages higher or the premiums lower in order to meet that affordability on some of your employees. So now we are going to talk about those notices. So we still see notices coming through for 16 and 17. Those letter 226J, those are your ESRP, your employer shared responsibility notices. If you get one of these, you still have 30 days to respond. You can call the IRS and ask for an extension. I have had people tell me that the IRS isn't granting as many extensions. I personally have not seen that. I would encourage you just to try and get that responded to immediately. If you read the Accounting Today magazine, you'll see on August 7th, there was an article out there saying that the IRS is coming down a little bit harder on the 2017 forms. They encourage you to get those forms reviewed by someone who understands the 1095C, understands the safe harbor on the 1095Cs to avoid any IRS notices. Letter 5699s, those are coming out to employers that didn't submit any forms to the IRS, and the IRS feels they may be a large employer. Now, I've seen this go both ways. I've had small employers get a letter 5699, and we have run a calculation, deem that they're a small employer, and what the client does at that point is just submits our letter to the IRS, and it typically clears up that matter. If you're a large employer and you get a 5699, make sure you respond to that. The IRS will grant you an extension oftentimes on responding to that. What they won't do is let you just keep ignoring that letter, so to speak, and not filing their forms. Also, if you have 250 or more forms that you have to file, I've gone to different IRS agents and asked them, hey, these employers have old forms they need to file. They have 500 forms to file. It's quite expensive to get a software company to file old forms. Can they paper file them? And there's nothing out there to allow the IRS to accept those paper filed forms without sending us a penalty back to you for submitting paper filed forms if there's 250 or more. So you're going to have to find a payroll software company or a company that will file those ACA forms for your entity if you have 250 or more forms. Now, this notice is the notice that I mentioned earlier, and this notice is coming out if you file your forms late. So remember, we had those small employers that were filing their forms and they didn't get to the IRS in time. They are getting one of these late filing notices. They can be cleared up. They're not as easy to clear up, in my opinion, as the letter 226Js or the letter 5699s. We still have a huge misconception out there that insurance companies are filing the 1095-C forms for clients. That is not the case. I have yet to see one insurance company that files those. Here's what's happening. Employers are going to their insurance company and saying, hey, I think I have a filing requirement under the ACA. Are you filing the forms for me? Well, the insurance company is saying, yeah, we're filing the forms for you. They're filing the 1095-B forms, not the 1095-C forms, because it's a fully insured plan. The insurance company has a filing obligation, as does the large employer. So make sure if you have a client that, comes to you and says that the insurance company filed them, you are questioning that. Remember, if you're a small employer or you are part of a multiple employer welfare arrangement and you're self-funded, you have a 1095-B filing requirement. If you're a large employer, you do have a 1095-C filing requirement. So here is the 1094-C for 2019. I have listed later what I see some errors being done, but while you're looking at this form, let's talk through those errors. So oftentimes I see line 18 and line 20 not being filled out correctly. Unless you're filing different divisions for the same entity, those two lines should always be the same. Certifications of eligibility, line 22, I see some clients not filling that out. And they could fill that out because they have a qualifying offer method, or they're offering the insurance to 98% of their full-time employees, and that offer is affordable. If those certifications of eligibility, if you meet them, you're to check those boxes. There's a benefit to checking that 98% method. You then don't have to fill out your full-time employee count to the IRS. And as we can see here, that's column B. Remember, less is more to the IRS. If we don't have to give the IRS information, why would we? The biggest error I see being done on the 1094-C form is that you're not filling out column A, and that's what's tripping most of the letter 226J notices. So if you're offering insurance to 95% of your full-time employees, check yes for all 12 months. Remember, you either fill out the all 12 months box or each individual month. So with that, let's go to polling question number 4. On page 3 of the 1094-C, what order do related entities go in? Do they go in alphabetical order, numerical order according to their EIN, smallest to largest, or largest to smaller based on the full-time employees? Okay, so it is largest to smallest based on the full-time employee. So if your employees don't fill out page 2, that full-time employee count, you'll have to go back and look at that. So there is your page 3 form. Remember that only applies to entities that have related entities. We talked about these errors on the 1094C. 1095C, we have a list of errors as well, but I'm going to go through them right now. You need to fill out every single month or the all 12 months. You don't fill out all 13 months for part 2. Uh, if you don't have a 1A offer or a 1G offer, you should have something in line 16 unless you didn't offer affordable or adequate insurance to that employee. If you leave line 16 blank, other than if you use a 1A code or a 1G code, you're opening that employer up for penalties. I see it all the time where clients will put in their line 14 codes and they'll leave line 16 blank for employees that waived coverage. That is not what should be done. If it's offered to that employee and it's an affordable offer, you should be putting in your safe harbor code so that the IRS knows that they shouldn't penalize you for that month. Remember line 15, you always put the cents in there. So if the dollar amount is $100 for employee only coverage, you would put 100.00. So remember that 1A offer is $99.75. We mentioned that earlier. Here are several codes that you could use. Nothing has changed from prior years, so I'm going to skip over these. 1G offer, if you have a self-funded plan and you're offering to someone who wasn't full-time for any month of the year, that would be a 1G offer if they took insurance. Remember, if you're self-funded, you'd have to give that employee or that recipient a copy of their form. You would use 1G. If you're using a 1G code, has to be used for all 12 months. You don't put a safe harbor code in and you don't put line 15 in. Here's something to think about. If you're a practitioner and you have an employee giving you a 1095C form, first off, do you have to get a 1095B or C form from that employee or that client? No, you don't have to. But if you do get a 1095C form and you do have a client getting, that same client getting a 1095A form from the marketplace because they received an advanced premium tax credit, what should you do? You should be able to read that 1095C form, especially if you're going to keep it in the client file. You have to read that 1095C form. If that client or that employee was offered an affordable offer from their employer, they do not qualify for a premium tax credit, and they're going to have to repay that premium tax credit. So my caution is for those practitioners out there that aren't familiar with the ACA, at least familiarize yourself with the 1095C form, know those safe harbors, know what those codes mean. Because if you're going to keep a copy of that 1095C in the client file and you allowed that client to have that premium tax credit and you didn't make them pay that premium tax credit back on Form 8962, and that client gets audited, assuming the IRS agent asks for that 1095C form in that file, they're going to come back to you and say, this client was offered an affordable offer. Why didn't they repay that premium tax credit? So make sure you familiarize yourself with that 2F, 2H, 2G safe harbor, or if a 1A offer is made, it's automatically deemed affordable. Here are your penalties. They're increased this year. Here's some misconceptions that we have with the ACA. Only ALEs file the 1094 and 1095 forms. That's not true. If you're a small employer and you have a self-funded plan, you do have a filing requirement on the 1094 and 1095B forms. Only employees who enroll in coverage need a 1095C form. That's not true. Anybody who hits the hours threshold for those large employers, they need a form, whether an offer was made to that employee or not. So look at their hours, whether you're using the monthly and you look at 130 hours per month, that employee needs a form. Or if you're using the look back and that employee hit 1560 in the look back, again, that employee needs a form. Insurance companies file 1095-C forms. This is a huge misconception out there. Payroll companies automatically file the ACA forms. Not true. You have to usually pay for that additional service, that additional module in your payroll software in order to fill out those forms correctly. Remember, the payroll software that you're using, it could be a great software, but the output's only going to be as good as the input. So make sure when you're inputting that information into that payroll software, you're looking at all the boxes, you're looking at that output, you're looking at that 1095-C form, make sure all the safe harbor codes are utilized correctly. All payroll companies have ACA experts. Some do, some don't. Make sure that when you're looking at their answers, that you're comfortable with it. That form, when it produces that form, if you're not seeing something if you're seeing something that doesn't look right, go back to the instructions and look at those and make sure that you input all the correct information to get the output correct. Some people thought we'd get rid of the ACA forms after 2018. We didn't. They're still out there. Another thing that I see being done, and then I'll let you guys go, is that companies don't print off their forms that they're filing through their payroll software. Well, when the IRS notice comes out and they have to give me one of those forms, that form has been updated once the payroll software updates. So make sure those clients are printing off their forms, putting them in a PDF, saving them somewhere so that when the payroll software updates, that old form doesn't get updated and we can see what the IRS sees. So with that, I do see we have some questions down in the chat box, although I don't know if they're questions for me, Eide.
There's only one question. We work with a professional employer organization. If they have over 100 employees, do they need to offer health insurance?
So so it comes back to the common employer rule. If that common employer has over 100, then yes, you have ACA forms to file. So you could be using that payroll professional company to do your forms. I get that. But it again comes back to the common law employer. And if you have 50 or more full-time equivalent employees, you do have to either offer affordable and adequate insurance to your employees, or you could be subject to the penalties.
Okay. Well, that is all the questions. So
Perfect. Well, with that, I know we went through some of those slides rather quickly. If you have any questions, send me an email. Give me a couple days to respond, only because I have a few more appointments today. Thank you, everyone, for joining us. I do appreciate it. I hope you have a good tax season and a good rest of your day.
awesome. Thank you so much. Have a good day, guys.